Most people assume their financial advisor has everything under control, but what if there are blind spots in your financial plan? Not because your advisor is bad at their job, but maybe it's because philosophies and best practices have changed, and maybe your advisor hasn't changed with them. The truth is, even well-meaning advisors can overlook some critical issues, and those little things, they can snowball into major setbacks like higher taxes in retirement, unnecessary risk, or missing out on opportunities that you didn't even know were there. This video is your behind the scenes look at the 6 most common mistakes even good advisors make and how to spot them before they can derail your financial future. Let's dive in. Now, the first mistake that financial advisors make is never reviewing your financial plan. You wouldn't set a GPS once and then ignore it for your cross-country road trip. You'd check in, reroute, update when there's traffic. That's exactly what your financial plan needs. One of the most common mistakes in financial planning is setting your plan and then letting it gather dust. That's a missed opportunity. Life changes, markets change, your goals change. Maybe last year you were saving aggressively, markets were strong, and you were on pace to retire at 65 when you structured your financial plan. But maybe recent events mean that you can now retire a year earlier. Or maybe it doesn't, but you won't know unless you review and adjust the plan. A good advisor helps you adjust course regularly, not just once, regularly, because staying on track requires checking the map every so often. And if your goals shift, maybe you want to retire sooner. Maybe you want to help your grandkids with college, and that wasn't a goal before. Or maybe you just want to work less. Your plan should evolve with you. If those conversations aren't happening, something's missing. The next mistake that advisors make is taking a one-size-fits-all approach. You ever hear somebody say that you should always pay off your mortgage or keep everything in stocks? These cookie-cutter recommendations might sound great on TikTok, but real life isn't a one-size-fits-all scenario. Financial advice should be personalized, period. Let's say you're in your early 60s with a low-interest mortgage. You could pay it off, sure, but maybe you'd rather keep it, invest your cash, and potentially earn a better return. That might make more sense for you. But if advice is given without asking the right questions first, that's a sign that the strategy might not be tailored enough. Effective advisors ask questions, they listen, they tailor their advice. Giving the same advice to everyone is like a doctor handing out the same prescription no matter who the patient is. Financial planning isn't fast food. It should be handcrafted, not mass-produced. Now, the next mistake that advisors make is taking too much risk. So a lot of financial plans are built around one question: how much risk can you tolerate? But here's the thing, tolerance isn't a strategy. Just because you can ride a roller coaster doesn't mean it's the smartest ride to take. Real planning asks, how much risk should you take in order to reach your goals? So there's a difference there. People think they need to shoot for the moon, but honestly, you don't win in retirement by having the biggest account. You win by reaching your goals. Some people want to bounce their last check. Others want to leave a legacy. Most just want peace of mind. But if you're taking too much risk, you might either run out of money too soon or never be able to enjoy it at all. I will provide the caveat that there is something called risk capacity that can be discussed in conjunction with risk tolerance with your advisor. Some might say that they told their advisor to take more risk, and this might be the case. But if the risk capacity isn't there and hasn't been discussed, meaning that you have the ability to hit your goals even if there were to be a market decline, then it might be appropriate if the risk capacity is there as well as the risk tolerance. But this is a specific conversation that you should have with your financial advisor, or they should have brought it up in conversation with you. Now, the next mistake that advisors make is ignoring taxes and retirement in their planning process. Here's a scary truth. Retirement can be the most expensive tax season of your life. If taxes aren't a part of the conversation, you might be missing a key piece of the plan. Why does this matter? Because once you hit 73, the IRS starts forcing you to take money out of your retirement accounts, whether you need it or not. Those are called required minimum distributions, or RMDs, and these are fully taxable at ordinary income tax brackets. So there's also Social Security. Most people don't realize it, but up to 85% of your Social Security benefits can be taxed if your income is high enough. That includes RMDs, capital gains, and dividends from investments. And if you need to sell investments in retirement to cover a big expense, That can bump you into even a higher tax bracket and increase your Medicare premiums. So smart planning means thinking ahead. Maybe that includes Roth conversions in lower income earning years, or tax efficient withdrawal strategies, or even just coordinating with which accounts to pull the money from. The point is, you should keep more of your money, not hand it over to the IRS because of poor planning. That's why good financial planning and good financial advisors often includes solid tax strategy. Now, more than likely, your financial advisor can't give tax advice, but they can certainly coordinate with your tax professionals and bring things to your attention. The next mistake that advisors make is overlooking healthcare in retirement. Let's be real. Healthcare is one of the biggest wild cards in retirement, and it's easy to overlook. This is because during your working years, a big portion of your healthcare insurance is typically covered by your employer, and the rest is taken out of your paycheck. Out of sight, it's typically out of mind. But it shouldn't be out of your advisor's mind. A well-rounded financial plan should include the cost of healthcare, even if it isn't provided to the advisor as an estimated cost of living. It's not just unexpected hospital visits, it's Medicare premiums, it's drug costs, it's long-term care. Medicare alone isn't free. There's Part B, Part D, those all come with premiums. There's Medigap or a Medicare supplemental, and if your income is too high, those premiums go up, and sometimes way up. Now, the last mistake that advisors make that I want to cover is not helping you build a team. Now, no advisor can do it all, and even the best ones don't try. The best financial plans are built by a team. A CPA to help minimize taxes, an estate attorney to make sure that your legacy is protected, a Medicare expert to help pick the right plan. Your financial plan touches more than just investments. It means taxes, legal documents, insurance, all of it. If your plan isn't pulling in or at least coordinating with these other professionals, you could be missing important pieces. Think of it like building a house. You wouldn't hire an architect and skip the electrician or the plumber. Why would your financial plan be any different? You deserve a team that communicates, collaborates, and looks at your situation from every angle. My name is Zach Morris, and I'm the founder of Paces Ferry Wealth Advisors. If you've enjoyed this video, please go ahead and hit the thumbs up below and subscribe. And thank you for watching today.